Hello and welcome to Cultivate's Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Cultivate. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Edilson Shahini, investment manager based out of our Birmingham office, and this week I am pleased to be joined by regular guest Richard Carter, our head of fixed interest research, and Ghaz, our fund research analyst. Good morning to you both. Richard, turning to you first. On our last podcast together back in January, we highlighted this would be a big year for politics and democracy. We are now past the halfway point in the year, and it's safe to say it has been eventful indeed. More recently, we've had the UK election, and we know the outcome of that. We're not real surprises there. We've had the French election as well, and that was more of a surprise. Then, of course, and arguably the biggest of them all across the Atlantic, the US election campaign seems to be in full swing, and Biden is clearly under the microscope. His conference at the end of the NATO summit last week was less dramatic, but it still offered moments to latch onto for those calling on him to step aside. Then, of course, over the weekend, things got a lot more serious with the attempted assassination of Donald Trump, which fortunately he's okay. Richard, what is your take on these events, and how does that impact sort of markets and ultimately investors' thoughts and decision making?
Well, you're right. It was a pretty shocking weekend in terms of the news on Donald Trump, which was a pretty close run things by the looks of it. I mean, I think being cynical or whatever, it's not going to have done his election chances any harm at all, really. I mean, the images of him sort of narrowly surviving the assassination attempt and sort of getting up and waving to the crowd, you really do think that's probably going to be good for his, as I say, for his chances of winning the election. So, I mean, but I think it's, in some ways, although it was a shocking event, it's kind of a little bit part of the trend we've seen over the last couple of weeks, ever since the sort of debate where Biden really struggled. And I think markets are increasingly pricing in, the chances that Donald Trump ultimately wins the presidential election. I mean, the narrative last week was whether Biden was going to need to step down, and obviously pressure's growing on him to sort of throw in the towel and let someone else run against Trump in November. That narrative or that discussion might ease off, I think, a little bit for now, while there's this focus on Trump and the assassination attempt. But I think overall, markets increasingly thinking about what Trump presidency looks like. If anything, if what he said and anything, like last time is anything to go by, there's probably going to be things like tax cuts, much stricter policies on immigration, potential sort of tariff increases on foreign goods. None of that's great for bonds, if I'm honest. Certainly seems a little bit on the inflationary side, when we've already got some concerns there as well. But probably for US equities or US stocks, it's probably not it's not bad at all. In fact, it may be pretty good. So I think you've seen a little bit of those sorts of movements in markets over the last week or so. We shall now have to go on and see whether Biden does run against Trump or he decides to stand down. But certainly that seems to be he certainly seems to be clinging on for now.
Turning our attention to inflation, the latest US CPI print surprised on the downside, with inflation falling to 3%, which is slightly more than anticipated, and edging ever closer to that 2% sort of target. This, in turn, led to increased bets that the US Fed will press on with at least one interest rate cut this year, with almost everyone now believing the first one will come in September. On last week's podcast, we discussed how then there was a 76% chance or thereabout of a US cut. Rate cut in September. Well, it's fair to say that has now sort of gone up to almost 100%, if not entirely 100%. Treasury yields reacted, and we saw a rally here in both US Treasuries and equities, which hit a fresh all-time high. On the other hand, in the UK, we had a surprise positive update on GDP growth. The combination of these led to sterling rising to the highest level in a year versus the dollar. Although it is too early to tell if and somehow England's run to the Euros final, having fallen just short of winning last night, unfortunately, has impacted GDP and perhaps even the decision on interest rate cuts. In your view, is there a chance we may very well now see a rate cut in the US before the UK? And has that influenced discussions and any asset allocation moves for us at Cultivate?
Yeah, UK. It's interesting because we've been talking about France and US. I think with the UK election out of the way and Starmer with a big majority, the UK potentially is a beacon of sort of political stability at the moment, which it certainly hasn't been in previous years. And with the sort of new government's pro-growth message, maybe that's sort of been relatively helpful for sterling. Although I think it's probably a fairly short-lived move, and sort of interest rate differentials will dominate currency movements as they usually do. Do I think you asked if I think it would be a rate cut in the US before the UK? Probably not much would be the answer, because if they both cut in September, I think the central bank meetings are within a day of each other, so it wouldn't be a huge surprise if they both cut pretty much at the same time. There is an outside chance the UK cuts in August. Certainly, inflation data is much better now, so it's possible. But I think generally they'll roughly be about the same time. But as I say, these political factors have been dominating currency movements last week or so. Has this influenced our discussions? Not massively. We're not expecting some sort of big, prolonged rally in sterling or anything like that. I think, when it comes to looking around the world, opportunities, certainly on the equity market, it often comes back to the sort of opportunities in the US and the tech stocks and all the rest of it. That seems to be where the best returns are likely to be over time, although the UK also has some attractive opportunities as well. But we're definitely sort of biased towards global equities. I think with bonds, the sort of absent the politics, the backdrop's pretty good. So we do quite like bonds at the moment. And I think when you look at sort of slightly lower inflation, rate cuts on the way, that's all good news for fixed income. But this the news about Trump and and the worries about the deficit in the States and tax cuts potentially are a little bit of a fly in the ointment at the moment. So we'll have to keep a pretty close eye on that. But as I say, rate cuts hopefully on the way, and probably not too much difference in the US and the UK.
Excellent, Richard. Ghaz, if I can turn my attention to you now, perhaps sort of change of direction slightly. We often talk about equities and bonds portfolios, and these being the two key components or core components, and perhaps less so on the alternatives basket. In a multi-asset portfolio, there can be clear benefit of holding alternatives. One of these areas in this basket is, of course, hedge funds or absolute return funds, and they can play an important role with the right allocation. Indeed, looking back over more recent times in the monetary cycle we've lived through, in particularly the massive ramp up in interest rates to tackle high inflation, hedge funds generally have been less volatile than bonds, especially those with greater sensitivity to interest rate cuts, i.e. those with longer maturities. Can you elaborate a little bit on this, please, and highlight some of the benefits for clients and reason why clients might want to hold onto hedge funds?
Absolutely. Thanks, Edilson. So first of all, I think it's important to note that the term hedge fund actually encompasses a very broad range of investment styles, asset classes, and points across the risk-reward spectrum. I think there's still a degree of perception in the layperson's mind that hedge funds generally are highly volatile, high risk, high return types of products. And I think that impression probably originates from the early years of the industry. In reality, the types of hedge fund portfolios that institutional allocators such as us construct tend to typically be significantly less volatile than traditional equities. And indeed, some allocators have used this category of investment as a bond substitute in recent years. Institutions can utilize hedge funds for various different objectives. Some of these include the introduction of a defensive, lower beta, less correlated return stream to their broader bond and equity holdings. They can use these funds to access securities, markets, skill sets, and investment styles, which are outside of the typical remit of traditional portfolios. And they can also use such funds to harvest the market return in a more asymmetric fashion. Hedge funds in general are able to operate with less constraints than long-only funds, and oftentimes they have more flexibility in things like the use of derivative instruments and leverage. And some of the markets, as I alluded to earlier, that hedge funds can tap into include, for example, commodities, currencies, distressed securities, etc., which are usually outside of the domain of the traditional portfolio. Turning to the cycle that we've experienced in the last 3 years or so, we've seen traditional bond and equity correlations break down, and bonds have been unable to provide that defensive and safe haven status that they are traditionally associated with. Instead, what we've seen is the bonds have generated high levels of volatility and large losses in cases for investors through the cycle. If you look back to 2022, both bonds and equities drew down in tandem, while our hedge fund model was able to provide a good degree of capital protection and preservation in a difficult backdrop. 2023 was more challenging, I think, for the industry, and we saw large capital outflows in favor of fixed income from the space. But nonetheless, they ended the year in positive territory. But I think really it's the first half of this year which has provided a good illustration of the diversification benefits of such strategies. So just looking back at the beginning of the year, there was a broad expectation of imminent rate cuts, and we as a house have also remained underweight alternatives in favor of fixed interest in line with that sort of view. However, the first half of the year did not actually turn out that way in practice, and what we saw was that this higher for longer narrative took hold, and fixed income was again unable to generate a return. In this kind of backdrop, hedge funds generally provided a strong first half of return in excess of the cash rate, and also with very low levels of volatility. They were also able to effectively protect capital in months like April when both bonds and equities drew down. So really, I think to recap, in addition to some of the benefits that I touched upon earlier, an allocation to hedge funds in aggregate can provide a relatively low beta, low volatility return stream to traditional asset classes, and that potentially helps low risk and volatility stats of broader portfolios. And it can also provide a better volatility risk adjusted return compared to mainstream assets.
And building on that a little bit, Ghaz, and I know you touched base on it, if we sort of focus and hone in a little bit more on this year and perhaps in the more immediate future as well, on the monetary front, policy, regulatory front, etc., how have things possibly changed for the hedge fund sector, and what trends are we seeing? What sort of things have done well and perhaps not so well?
Absolutely. So I think just looking back to Q4 of last year and entering into this year, we saw generally an improvement in the backdrop for a number of strategies, and that has subsequently translated into better returns. So as a sort of examples of some strategies which have experienced that, we saw in equity long short that managers have consistently been reporting improving dispersion and stock returns in a backdrop of low index level volatility. We've seen event-driven and special situations funds benefit from a renewal in capital markets and deal activity. We've seen medium-term trend followers benefit from a number of consistent trends across multiple asset classes during the earlier part of the year. And equally, multi-asset funds, which have generally been positioned defensively, have nonetheless benefited from their equity exposure and contributed positively in general. Needless to say, directional equity and directional credit funds have gained ground as equities rallied and credit spreads tightened. But I note that these are two strategies that we tend to avoid, given the highly directional nature of these funds and the rising beta that comes with them. On the slightly more negative side, we've seen some macro funds struggle to navigate the shifts in market sentiment towards the timing of interest rate cuts. And we've also seen some thematic funds facing headwinds in the first part of the year. So, I mean, just sort of taking a step back and looking at things from a higher level, we've shifted from a regime of quantitative easing to a regime of tightening, where central banks have stopped playing the role of vol suppressors, and so normal market forces are better able to express themselves. And equally, what we've seen is higher cash rates are able to benefit directly and indirectly in varying degrees a number of different strategies. So from a high level perspective, things look better than they did in the quantitative easing era. The impact of a prolonged period of higher rates should continue to generate winners and losers across the corporate world, and that's of benefit to both equity and credit managers. And there are other things at play, such as AI, for example, which again create winners and losers for these funds to invest in. Within fixed income, factors such as a more normalized central banking function, higher levels of government bond issuance, etc., can be favorable for fixed income arbitrageurs. And as we alluded to earlier, diverging macroeconomic regimes across various countries can possibly be fruitful for macro managers as monetary policy diverges between geographies. The peak of the rate cycle, I think, also suggests more corporate confidence, and that means more capital markets activity and deal activity should persist. I think the opportunity set at this point in time generally looks reasonable. However, as always, there are several risks that we need to be aware of looking forward. Markets have had a relatively steady run this year, and that may not last, while sensitivity to incremental data releases is high, and that can be difficult to navigate for thematic managers, for example. And equally, it has the potential to trigger whipsaws and large factor-based rotations, which can be very tricky to manage around for multiple different strategies. Equally, there's the element of regulatory risk, as well as the sort of US election and other political risks, which can create headwinds and uncertainty. And most of all, though, it's the unexpected market shocks that tend to harm returns in funds like these. Although in the medium term, they can generate opportunities as well. And I think finally, it's worth mentioning that hedge funds themselves tend to generate a broad dispersion of returns. So while allocating capital to the space, manager selection, diversification, and portfolio construction remain key considerations.
Excellent. Thank you, guys. And Richard, very quick question, if I may put this back to you. Because I was reading the other day, quite interesting, actually, how England's running the Euros, albeit they've just fallen short of that, may in fact even lead to a delay in interest rate cuts for the Bank of England, and perhaps give them a little bit of a point to think about, I suppose. So just to get your thoughts, do you think that's more of a myth, or do you think the argument sort of carries weight, and especially if they had actually gone on to win it? And I guess the angle that I'm coming from, or the argument for it, is sort of consumption and other gatherings, people spending money, watching football, etc. But what is your thoughts on that, really?
Yeah, it could do. I mean, we won't know for a couple of months until the GDP numbers come out. I mean, the Bank of England probably looks at. I mean, you had the football, obviously, and you have various other events. I mean, not least Taylor Swift concerts and all that sort of stuff, which does add to GDP at the margin, and may make the Bank of England think, do you know what, the economy's too strong for us to cut rates at the moment. However, you would hope that they are kind of looking through that a little bit. Interest rate cuts take a bit of time to come through in terms of their impact. You would think that they're forecasting growth going out, a few quarters, and inflation as well. And I think the fact that inflation's come back towards target means that England's run to the final isn't going to make too much of a difference. Obviously, had we won, I think there might have been a bank holiday called, or something like that. I could certainly imagine about 6 million people descending on Trafalgar Square to try and celebrate it. So that could have had actually quite a big impact. Although I think had we won, I think there would have been quite a few absences from various offices around the country today. That's for sure. But no, I think. Let's say the Bank of England's focus on inflation, and that seems to be coming down as planned.
Okay, well, thank you. And thank you both for the great insights. And to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your social, and tag us at Quilter Cheviot. To make sure you don't miss future episodes, tap the subscribe button. We'll be back next week. And in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have any questions you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comment page on our website. We'd love to hear from your questions. That's it for today. So thank you again, Richard. Thank you, Ghaz, for your time, and all of you for listening. See you next time.